welcome everyone to Business Legal Lifecycle TV. I'm Jeremy Stretton and this is Craig Mason.
Hi everyone.
And we're here today to give you your weekly education about the law and how it applies to business. So today's talk is going to be about financials and finances, and this is a topic which is very important to business owners. Please, if you've got questions or comments as we're going, we've got our Facebook up here on the side. So please ask any questions. We'll be happy to answer them as we're going. And as always, if you're watching this on the replay, please make sure that you ask any questions of us in the comment section, or send us a private message. This topic is all about phase 2 of the business legal lifecycle. Now, phase 2 is a startup phase, and so what it's about is about what you need to actually do from your business to actually start it up quickly and properly. So I'll flick over here to the business legal lifecycle. So if you haven't seen it before, a copy of it's here, and you'll see phase 2 is startup is right there. So that's what we're talking about today. Craig, you got anything else to add before we get cracking?
No, I think let's hit it.
All right, excellent. Well, I'll just flick over to the slides, and just for the format today, Craig's going to talk about financials, and I'm going to talk about finances. And as always, the one thing I did forget to mention, Craig, was the free offer. So please watch this to the end, and we'll be telling you what our free offer is this week. To do that, you need to go back to the beginning and look for the free code word, which came up in the first 5 to 10 seconds, and then you'll be able to get that. So let's flick over to the slides and get going. So Craig, I'll hand over to you.
All right, so financials. Pretty big topic, obviously, as you start up in business. You need to know about your financials, or you might not last very long. So we're going to talk about the financial documents that you'll get from your accountant or bookkeeper, whoever it might be. And then Jeremy's going to talk about actually borrowing the money. So in terms of financials, now as you're starting up, obviously one tip that I think we learnt, a lot of businesses learn, that when you're trying to save sort of costs and do everything yourself, probably the financial side of things is probably one to outsource and get an accountant or a bookkeeper involved. I've got an accountancy background, and so I was kind of doing it at the beginning, but it takes up so much more time trying to do all this stuff and enter things in MyOb and QuickBooks and all those sort of things. So I'd encourage everyone, as we say a lot during these episodes and throughout the business legal lifecycle book, your advisors in business are very important. And I think this is where your accountant and your bookkeeper really earns their money. So ideally, your bookkeeper will be providing certain reports during the periods of time throughout the year. One of those reports is going to be a profit and loss. It's also called an income statement. You might have heard of that, but obviously it's a profit and loss statement. So this is an example of what one would look like. Obviously, there'd be some things next to the dollar signs, but you've got your income. So that's the money that's coming into the business, so your sales, any other income that you might have. You've then got your cost of goods sold. So that's your actual costs that you incur to sell your particular good or provide that service. And then you've got your expenses. So accounting's obviously one that we've already said encourage you to have. Advertising, marketing, continues from there. So obviously with a profit and loss statement, you want the revenue to exceed the costs. And if you do, then where it's got profit and loss, you have a positive, so you've got a profit. That's obviously what we want, and that's what business is for. But when you're starting up, sometimes your income, or the costs, and your expenses might exceed your income, and you'll have a loss. And so the loss normally will appear in brackets or with a minus sign next to it down the bottom there. So if your costs are higher than your income, then obviously there's a deficit, and you're incurring a loss. So when you get that statement, you see that. Hopefully that's not the first time you realise that you're making a loss for the month, potentially. You've already taken steps. But that's a report that you'll get from your bookkeeper or your accountant, and that's one to obviously look at. You'll see there, and there'll be other things that we'll talk about. Not necessarily always in today's episode. This is more for the startups, but as you go along, studying the trends and doing all those sorts of things with these sort of reports is really important within your business. So that's your profit and loss. So the profit is obviously what we want. The next one is a balance sheet. So that's a snapshot at a particular period of time as to the assets, the liabilities, and the owner's equity, or whatever you want to call it. It's different terms, but assets equals liabilities and equity. So obviously it's called a balance sheet because it balances, hopefully. Except if you're someone like me and did uni and accountancy subjects and didn't quite manage to always get a balance sheet to balance. But the idea is for that to balance, and your accountant will always make sure that it balances, because debits and credits and those sorts of things, it's got to balance. That's the point. So you've got your balance sheet, you've got your assets, so your cash in your business, accounts receivable, so that's obviously the money that's coming in or is owed to you. Your inventory, if you've got a supply business or something, so that's all your stock. Then you've got your long-term assets, so business improvements, those sorts of things, and that gives you your total of your assets. So the total of that will equal the total liabilities plus the total equity. So liabilities, pretty self-explanatory. Accounts payable, so that's what you have to pay to your suppliers or advisors, wherever it might be. There's other accrued expenses, those sorts of things, which equal your total liabilities. Then you've got your owner's equity. So that's could be investments, shareholders' investments, your retained earnings, retained capital, those sorts of things. So that equals what your equity is. And provided it does balance, then your total assets will equal the bottom right-hand corner there. Will also be your total liabilities and equity. So another one. It is a snapshot. You can't get a lot out of that because it's going to be at sort of the end of the month or the end of the quarter, and you'll see that. Obviously, at that point, you can't take any steps to change any of that. That's already occurred. So, but it's still something to look at. Sort of when you're getting your reports, it's probably going to be your balance sheet. And it sort of bookends at the end. You'll get another balance sheet, and throughout that period of time, you'll be getting profit and losses and hopefully other reports, which I'll get to shortly from your accountant. And if you're not getting them, then it's probably not a bad idea to ask about that. The other one, and it's a couple of slides away, so I'll leave it at the moment. But one of the most important things with any business is cash flow. Obviously, without cash flow and cash coming into your business, then you're not going to have a business, and that loss column on your profit and loss is going to be a loss. So you want to do what we call a 13-week rolling cash flow, and you can see there's an example of that. It's obviously got the weeks 1 through to 9, your sale, your costs, and those sorts of things, and it's similar sort of to, and it sort of works with your budgets as well, which is the next thing I want to talk about. But when you're doing your cash flow, you might be in a particular business where you might be supplying goods on credit, for instance, and your terms are 30 days from the end of the month. So when you're doing your cash flow, forecasting and those sorts of things, you should sort of know that particular times of the month you're going to be receiving more cash. So that's an important thing to know, and it also is your terms and when you're paying out money as well to your suppliers. You might be 21 days that you've got to pay your bills and those sorts of things. So that is part of the process of doing the 13-week rolling cash flow. Taking into account, you don't just sort of make things up. Same with the budget, sort of based on some level of science, I guess. So that's the 13-week rolling cash flow, and from that, as I said before, there are some trends and things like that you can work into the reports. So obviously the big one when you're starting out is your budget. So this is one that's not necessarily going to have your bookkeeper giving you a report, but it's something that we'd encourage everyone is within their business, whether they've been around for 12 minutes or 12 years, to always have some form of budget projections. And so this comes back to, similar to what I was talking about before, knowing sort of when things are busier, for instance. So you might be a pool shop, and Christmas time, summertime's popular for buying chlorine, but in June you mightn't have many people buying chlorine. So when you're doing your budgets, you can take all of that into account as to know when your sales are up and when they're down, And further to that, when you look at those sorts of things, you know that your sales might be down in June, like we know particular months when we're down, and you might run a promotion that chlorine's 2 for 1 in June, so everyone stockpiles for the summer for their pool, something like that. So that's the way to look at it, and pick up on things like that. And then particular months you might have higher expenses as well. You might be running an event once a quarter, so that particular month the expense is going to be higher, or those sorts of things. So it's something to look at. It's not do it once and then sit there and never look at it again for 12 months. I mean, we look at ours a couple of times a month at least, I guess.
At least.
Checking it out, make sure we're hitting the budgets or why we're not, and we can look at the trends from there as to we budgeted for $5,000 for that, but every month it's been 7.5, so obviously you're adjusting your budget to be 7.5 or whatever that might be. So it's a good thing to have, the budget, obviously, and any good financial person will tell you that. And the last one is the statement of cash flow. So this is one that you'll get from your bookkeeper or accountant normally. Pretty self-explanatory. You've obviously got your beginning cash. So for a particular period, you've got $12,000. So your operating cash flow is your actual sales coming into the business. Your investment cash flow might be if you sell a particular asset or buy a particular asset, that would go in there. And then your finance cash flow is borrowed money that's coming in or going out. And then at the end of that particular period, you've got an end cash. So you'll see there you had 12. You've got $12,000 worth of operating cash flow. So you're now at 24. Paid out 4. I don't know why I'm doing this maths. That's 20,000. And then you've also had to pay a loan back for 5. So your end cash on that case would be 15. If anyone wants to check that maths, send me a message if I got it wrong, but I think it was 15. So you obviously see that your beginning cash, what you spent money on, and your end cash. In the statement of cash flow, you're not going to use your balance sheet, your profit and loss, and your statement of cash flow as your only reports and things that you look at from a financial point of view. You're definitely going to be using your rolling cash flow and your budget projections, because you can see from those that you're not getting a moving sort of target as to what's happening. So I would encourage everyone to make sure you've got the budgets, the rolling cash flow. It might seem a bit daunting sort of looking ahead, but you can do it for a couple of months in advance and then do it again and so forth. Particularly when you're starting out, you're not going to have that much idea, but having some sort of budget in place knows that if you're going above it, then you increase your budget, or if you're going above it but you don't want to continue it that way, then you need to take steps to decrease that expense or whatever it might be. So they're the financials that I want to talk about.
I'm just going to throw you a question without notice, Craig.
Okay, cool.
It's something that I'm surprised often how many business owners don't understand. And that's the difference between accrual accounting and cash accounting. So to give you an example, we've had clients in the past who've come to me and they haven't understood why their accounts say that they've received so many dollars when they actually haven't received that cash. And so we've had to explain the difference between accrual and cash accounting. Do you want to just explain what the difference is there? Because I think it's something that a lot of people don't understand. It's probably worthwhile throwing in at this point.
Yeah, well, I mean, cash accounting is what it says. So it's when you get the cash. And accrual is, so you might invoice, but you don't actually get the cash. So the accrual way that you can know what you're billing out and what you're going to be receiving, whereas cash accounting, you're only going to know when you're actually getting the cash. So from a reporting point of view, accrual, from an internal sort of reporting, accrual is probably the way to go, but it's not for everyone. I don't profess to be an expert in accounting. Talk to your advisors. But that'll give you an idea of what you've sent out, particularly if you're providing services on credit or goods on credit, you're going to know. With the cash, you already know when it comes in. But for tax reasons, when you're reporting to the tax office for GST purposes, then you might want cash, obviously, because then you're only paying GST when you actually receive the money, not when you're billing out, which is the accrual way of doing it, which you can do both.
Yep. Excellent. Yeah, cool. It's just something that occurred to me as we were talking, especially when in the balance sheet where we had accounts receivable as one of the assets. a lot of people don't understand that. So I thought that was
Yeah,
important to get
absolutely.
across. So again, please, if you're not sure about that, ask us questions. We've been doing this for a long time now. If you want to talk to your advisors, then they'll be able to explain it to you as well. But getting a simple explanation of these things is often very important. So that's the first part of today's presentation. The next is on finance. So I'm going to talk about some different types of finance, and I'm going to give some examples of where some of these can go wrong. So there's about 5 or 6 of these different types of loans that people can get. And the purpose of today is to basically, because we're in the startup phase, is to give you a broad overview over what they are, what some of the pitfalls can be, what some of the advantages can be, and then what maybe an example or two for some of them about where people have gone wrong. So the first one and the most obvious one is a bank loan. So anyone who owns a house has probably got a bank loan unless you're able to buy it with cash up front. And if you have been able to, well done. But I think 99% of people, at least when they buy in their first place, would have at least borrowed money. But from a business point of view, businesses can borrow money as well, and they're pretty straightforward. They're usually a better interest rate than most other borrowings that you can get, and a bank loan is something that will let you get the right loan at good terms with a financier. One thing to be really careful on, and this comes back to using your bank as opposed to a mortgage broker. And we'll talk more about this in phase 9, investing in property. But where you borrow money from a bank and you're a business owner, the simplest place to go to is the bank that you bank with at the time. So we bank with one of the big 4, both personally, and we also have a couple of business credit cards. Those credit cards, if they're with the same bank as our home loan is with, the liability on the debt is actually secured against our house. Now, a lot of people don't realise that, and in fact, a lot of banks don't, and bank officers don't realise that as well, that if you have a loan with a bank in your own personal name, and your business borrows money, and you provide a guarantee for that business, the loan, the mortgage that's registered over the title to your property is what is called an all monies mortgage. So that all monies mortgage will set out that that mortgage stays on the property until every single cent that you possibly owe that bank is paid. When that's at 0, then they can release. Then the mortgage can be released. Now that's important because whilst you might get loans when you start out and everything's going fine, you may not realise that if things go bad and you've deliberately siloed your assets. So last week we talked about the structures and talked about having different structures set up for businesses and personal. If you've got your business stuff set up as one entity and your personal in another, the last thing you want to do is have those entities be attacked that own the property. So you need to be really careful with the loans that you get and make sure that they're the right ones for you. So getting the right loan and the right approval is critical. Don't please just go to your bank. I know the temptation. The temptation is to go to your bank and to talk to them and get the loan through them, and that will probably be the easiest way. But at least talk to a mortgage broker or another bank if you don't know a good mortgage broker. If you don't, let us know. We know plenty of great ones, and they will help you get the best deal possible for your loan. So that's bank loans. Very common. Very, very important that you know what they are, and most people will have had one, but just be aware of that difference, that if you provide a personal guarantee for your business, which will almost always be required for a bank, that if that bank loan is with the bank that is over your property, the liability attaches to that property. So that's a really important one. The next one is capitalisation. So this is all about the ways that you can get money for the business, and one way can be to get capital from the shareholders and put it into the company. So if we go back again to last week, and I will go back to last week a fair bit here because that's all about structures. When you set up a company to trade, the company is owned by the shareholders, and the shareholders have what we call a share capital in that company. Now, that is usually $2 or $10, but the shareholders can buy a greater stake in the company by putting more money in as capitalisation. Now, it's something that a lot of small businesses won't use because often they'll want to loan the money into their company from a director if you're going to do that. but capitalisation can be used to increase the value of the property. Of the business. The next one and the third one is the angel investors. So, what's an angel investor? An angel investor is basically someone with a lot of money who looks at investing in companies without a lot of due diligence and just to help them out. And because they think they've got a good business idea. I'll talk a bit later about venture capitalists, and they're slightly different. They do a lot more looking into the business. But an angel investor will look at the company in a broad sense, make sure that it's at least a minimally viable business, and then will invest money in it. So they're not just going to give money willy-nilly, but they'll give money where they can to help out a business owner. I guess with any investor, and we'll go through more of this in phase 6, which is bringing in investors. With any investor, they're going to want something back for their investment. So whether that's shares, a loan, some sort of security, you need to be really clear of what they're actually getting in the business. So if they're getting shares, what are you giving up? The share capital, as I said before, that's the number of shares that are in the business. If you've got 100 shares at the beginning and you end up with 50 shares because you've had to give up 50%, then you've got to be aware of the changes that makes to your business. So angel investors are great. Often they're very, very kind-hearted people who will help out and will put the money in without any problems. But you need to be really careful about who that person is and what you've got to pay for that investment. So that's angel investors. Just check it. We don't have any questions. The next one is crowdsourcing. Now this is something that is coming up more and more. I was listening to a podcast about an Australian business this week who runs a magazine, and they crowdsourced when they decided to. It was an online magazine, and they decided to crowdsource to produce a book that they were running. So crowdsourcing is basically getting lots of people to make small contributions in return for something. So in that case, what they were doing was they crowdsourced the funds to print and market the book. And in return, each person got a copy of the book, and each person had to make a small donation. And that way, they were able to pool a lot of people's money together, to give out something very small, which was a copy of the book, and they were able to fund a large, probably 1.5 times their original investment idea. And so the amount of money that they were requesting to actually fund the business. It's a big thing in America, not so much over here, at least in the spaces that we've seen. But it's something that there are websites where you can, I won't mention any names, but there's websites that you can go onto that can basically you put your name up there, what your business idea is, and then people can choose to invest in your business. It can also be at a smaller level where you might have a bunch of investors who will look at putting money in to a business. Now, you've got to be really careful as to, again, what they're getting for their money and what they're actually giving to you. So crowdsourcing, it's a new one, or especially new in Australia, but one that's interesting and that you should have a serious think about. At the beginning, I talked about venture capital, and when I was comparing that against angel investors. And venture capitals is a business that's been around, a type of business that's been around for many years. And a venture capitalist is someone who will look at investing in money into a company. They'll usually require some pretty hefty returns. So whether that's shares in the company, entitlement to some sort of income, or a seat at the table. So in this picture, I've put a board table because basically a venture capitalist will want to be a member of the board. They want to be involved in the day-to-day running of the company. Now, there are lots and lots of horror stories about venture capitalists, but there's also lots and lots and lots of really good stories. Now, venture capitalists usually don't put money into a business unless they really see a really good product and they really see something that they're serious about. But as with everything with these venture capital, you need to be sure of who is investing in your company and make sure that you're actually getting the right person for the job. So the last couple I wanted to spend a bit more time on, and the first one is equipment loans. So equipment loans are often used in business, and the small to medium-sized businesses watching today will often use equipment loans to help them to fund their business. So it might be a car to operate the business. It might be a piece of machinery to operate an excavator, or a crane or something that's actually used to operate the business. Now, an equipment loan they're a funny beast. There are different ways of doing it. There are bank loans, which are essentially lines of credit that are secured over all of the assets of the business. And other times you can get a loan that's just secured over the asset. So what do I mean by secured? So in Australia, about 7 years ago, 6 or 7 years ago, I think it was, they brought in the personal property security register. Now that was to replace about 20 to 30 different registers where you could register security over a personal asset. So in Australia, we have a thing called the Torrens title of mortgages for property. And that means that the person who's registered on the title is the owner, and anyone who has a registered interest after that has an interest in the property. So a bank will have a mortgage over your property, most likely, and other people might have an interest as well. There was nothing Australia-wide or even state-based that was one system for each type of security and over each type of assets. There was one for motor vehicles, there was one for company assets, there were different ones for boats, there were different ones for all manner of different pieces of equipment. So the federal government brought together all of those and put them into one register, and that's called the Personal Property Security Register. So when you get an equipment loan, you need to think about what security you're giving for that loan. Now, when you borrow money from a bank, they will generally take a guarantee from the directors, and they'll generally take a loan over the assets of the company. Now that's what we call an all-PAP loan, and that's an acronym, and the actual terminology is escaping me for the moment, but it's essentially a loan over every single asset that the business owns. Everything from desks that we're on today, to computer mice and everything. They have security over all the assets. From a practical perspective, they'll never go after them, but they have all of that so that they can, if they so deem it, go and take those assets and sell them. Why does that matter? Because it matters from the type of loan that you're giving and the type of security that you're giving, because what happens is a lot of people don't realize they've given security over all of their company assets, and something goes wrong with that loan, and all of a sudden all of the assets of that company are opposite. Really apologise for this. Our phone is just ringing. Had a few issues with that today. But an equipment loan is a loan that is over all the assets. The alternative to an equipment loan is the alternative to an all-PAP loan is a loan that's secured over a particular asset. So if you've got a loan over a particular asset, so a car. So when you get a car in a company, they'll take that loan over that car and that car alone. So so you've got to make sure what the security that you're providing for that equipment is properly documented and properly registered. So have a look at that. An example I wanted to give here was when they had all these different registers and they brought in the one register for Australia-wide, there were a lot of all of the registers and all of the information on those registers were migrated into one system. Unfortunately, as you can imagine, when you're integrating 20 to 30 different registers together, a lot of the data missed and didn't attach itself to the right points. So a lot of people might have thought that they had a security registered, or might not have known they had a security registered. They've done a search and it hasn't come up. You need to do lots of searches to make sure that it's been done correctly. There was a transitional period that expired about a year ago, where they could be fixed. But you need to be aware of these things if it ever does come up. So equipment loans, very important for businesses, especially businesses that use plant and equipment to operate their business. But you need to make sure of that, and that the right loan's in place and the right things happen for you. So that's equipment loans. I don't have any questions on that one. And the last one are family and friends. So again, I've put a nice picture there that's of probably not really a family, but we'll say they are for the purposes of this slide. But they're a family, and they're all happy because they're investing money. This is something that you really need to be careful on. Family and friends, with all the best intentions in the world, are probably the worst investors in your company. there's a story that I've told before. If you've listened to it, any of the podcasts that I've done interviews on, and it's really telling because there's probably 100 different examples I could give, but this was an example where a young man was starting up a building company. The company had been running for a month or so, and his father-in-law, who had never worked in a business, offered to give him some money. Now, there's probably alarm bells going off in your head straight away, but he offered to give him some money, and he thought that was a great idea. Now, the father-in-law, who was a lovely gentleman and had all the best intentions in the world, had never operated a business by himself. He didn't know what had to go into a business and what had to go into growing a business. So the young man with his business went and borrowed the money from his father-in-law. There wasn't much security given. It was kind of done on a handshake. There was never a discussion over what the father-in-law's role would be in the company, what the boundaries of that were, and what reporting was meant to go on between the two of them. That's probably, even to come back to the other types and forms of funding that we've talked about today, is probably the biggest mistake people make, and it's a lack of communication. If you don't communicate and tell people what's actually going on in the business and what but more so what their actual expectations are and their roles and responsibilities if they're borrowing money, that's when the most problems come up. So this young gentleman has gone into the business. He's operated it for about 6 months. Unbeknownst to him, his father-in-law was in the background, again, not meaning to watch what was going on, but quite closely following what was happening. Now, he'd never built a business before. He didn't know that you had to. He hadn't thought of the fact that he needed to network, that he needed to go and see clients and spend a bit of time with people on the job sites. So he would rock up to the job sites and see that the son-in-law wasn't there. Find out, maybe check him out on Facebook, and he might have posted a picture that he was out with another prospective client. And because he didn't understand what was going on and what the son-in-law was doing, a great deal of angst built up in the family to the point where Christmas almost didn't happen. Now, that may sound like an extreme example, but it happens all the time, and it's quite sad. Borrowing money from family and friends is problematic at best. Not communicating is probably the one line where people don't communicate the most. So you should avoid it at all costs. If you are going to do it, make sure that a loan agreement is documented, and in that, the roles and responsibilities are clear over what everyone is doing in that business. Because if you don't have that done properly, then that's when problems arise. So document and communication, they're the keys to making sure that works. So that's the final. I think that's the final one of the slides today. I'll just flick back to our camera. So yeah, Craig, do you have anything to add on that?
Yeah, well, I guess two things. One is following on from what Jeremy said with family and friends. You treat it the same way as you treat getting money from a bank. So look at it from a commercial basis. Have the same agreements, those sorts of things. You can still give high fives to each other at Christmas time and do all those sorts of things, but you want to have an agreement in place so everyone is on the same page. If something happens, and it mightn't even be what Jeremy was talking about, where there was issues. Something might happen that means that someone's got to either exit the business or needs their money paid back or whatever it might be. And having an agreement in place as to how that's all going to happen at the beginning is going to be beneficial. So if you are looking at doing it that way, then make sure you treat it like a commercial arrangement. Doesn't mean you both have to get lawyers at 10 paces and yell at each other, but just get an agreement, everyone's on the same page, and then you'll know that if something does happen, that you've got an agreement there to dictate that. And it's supposed to be an agreement is supposed to be fair for everyone and basically govern the transaction. So it's not just one-sided to one party. So that's what I want to say about that. But obviously from that sort of flows into what we're going to be talking about on Monday, which is the top 3 financial pitfalls that we've seen in business. So we mightn't use the borrowing money from family and friends one now. We'll come up with another 3, but so the top 3 that we've seen financial pitfalls. So we're going to be doing that on our Fast Fix Monday, the 28th of August. As Jeremy said before, if you saw the beginning, you would have seen the free code word. So if you did see it, or you're now madly rewinding, if you put that in the comment section, or the first person to do that, will get whatever the free code word is.
I reckon we make it the first 3 people, Craig,
All right,
this
we'll
time.
go.
Let's go. The first 3 people to write something in the comment section, or write the code in the comment section, or to send us a private message. We'll send them a copy of the book.
Okay, all right. Twist and we'll do 3. So, yeah, Monday, 28th of August, that was our episode about financials and borrowing money and how you're going to fund your business. Obviously, as a startup, it's pretty important, but it's relevant for everyone throughout their business. They might need to either borrow money or look at their financials more closely. So I hope everyone got a lot out of that. As Jeremy said, I'm Craig Mason.
And I'm Jeremy Stratton, and we'll see you on Monday. And any questions, just let us know. Thanks very much.
See you later.